If you could give her a warm round of applause. So thank you for joining us tonight, Marci Rossell. Thank you.
Thank you so much, Michael. Well, I want to start with sharing a little story that happened to me about over a year ago, about 15 months ago. It was in September of last year, actually the year before, so 15 months ago. And I wake up one morning, and I had just sent my daughters, I have twin daughters, off to college. And one of them was in college in New Orleans at Tulane University, and I got a text message from her at 8 o'clock in the morning. Does anybody here have college students? If you got a text message at 8 in the morning, what would you think? Yeah, bail money, right? I mean, she needs bail money. She's in New Orleans and needs her first dose of bail money. That's not actually what it was. I sort of looked down at my phone, and the text message read, "Mom, is the world going to crash now that that investment bank has gone under?" She, of course, was talking about Lehman Brothers. And I said, "Oh, wow, this is, serious. She's really plugged into current events. She's worried about the state of the world, and this deserves a response from her mother." And so I text messaged her back a treatise on creative destruction and how it was all going to be okay anyway because she wasn't going to graduate for 4 years, so it didn't really matter, and she was going to go to graduate school. She texts me back 2 lines. She says, "Great, because they're freaking out on the Food Channel." Has that been your life for the last year? They've been freaking out on the Food Channel, on ESPN, just about anywhere you turn. I laughed the other day and said, I had a different color hair when this all started. It has been quite a year. And I think one of the reasons why my daughter Easton and many other people don't understand what has occurred over the last 18 months is that they simply don't have any historical perspective. It feels as if it kind of showed up out of nowhere, didn't it? What I'd like to do today is put some historical perspective around the financial crisis that's occurred over the last year, and in doing so, give you some sense of where I believe things are headed. 3 crucial elements of economic recovery that I believe make this recovery very different than the recoveries that we saw in 91 and 2001. But in order to do that, I have to share with you what I think this crisis has been about and why I believe it's actually rooted in events that go back to the Asia crisis of 1997. Does everybody remember the Asia crisis of 1997 in this room? Absolutely they do. To understand the recovery that's taking hold, because I actually do believe that the economic recovery began about 3 months ago. If you look at the data, it was about 3 months ago when manufacturing began to increase again. It was 3 months ago when consumer spending began to increase again. All the leading economic indicators have been suggesting, really for the last 6 months, if you look at the recovery in the stock market, that economic recovery is here. My question to you is, does it feel that way to the average American? No, because what are they looking for? One thing. Jobs, 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 jobs. And I've heard this in every single recovery. They've been calling them jobless recoveries, right? This is a term that took hold, the jobless recovery, the jobless recovery. Well, if you actually look at every recovery, with the exception of the 1981 recession and recovery, which doesn't count because that was a Federal Reserve engineered recession designed to break the back of inflation, so it wasn't a real recession in the traditional sense of the word, so you have to just take that out of the data set. If you look at every other recovery, jobs are the last thing to come back. And in fact, the unemployment rate always peaks after the recession is fully done. Every recovery is a jobless recovery. Every recovery is a jobless recovery. There's nothing special about this one. This one is deeper and more painful than anything we've experienced, most of us, in our lifetimes. But our perspective around recessions, I believe, was distorted by the last one. I'll share that with you in just a moment. Every recovery is a jobless recovery. You see, it is not jobs that give you recovery. It is recovery that gives you jobs, over and over again. And I will share with you at the end of my remarks, I'll save it till the end, where I think job growth comes from in the next year. I do expect job growth in 2010. We've already started to see sort of, even though we got a terrible number from the labor market today, I believe that the stimulus funds that filtered into the economy in the latter half of 2009 are distorting the recovery. So they're making 2009 look better than it really should. They're going to make early 2010 look worse than it really should, simply because of the way the stimulus money has been doled out. I don't even really like to call it stimulus money because that almost sounds like a good thing instead of a bad thing. So we'll call it something else like cash for everything. That gets us to, though, historical perspective. Putting this recovery into historical perspective, and to understand it, you must go back to the Asia crisis of 1997. Now, when that crisis broke out, I was just a youthful economist at the Federal Reserve Bank of Dallas. I hadn't even started wearing makeup yet in my career. That's how long ago it's been. I was a new economist at the Federal Reserve Bank of Dallas. The Asia crisis breaks out, and in the United States, we expected to have a recession in this country in 1998. So if you were involved in financial markets back then, you will recall that when that crisis broke out, it began in the developing world. It hit Thailand, Korea, Hong Kong. It spread, the financial crisis spread to Brazil and Mexico, right? And it just was sort of filtering out everywhere. We expected eventually to have a recession in the United States. Did we? No, actually, there was no recession in the United States in 1998 for the following reason. And this is important to understand: commodity prices. When the Asia crisis broke out in 97, the price of oil collapsed. Now, I, being an economist at the Federal Reserve Bank of Dallas, obviously would cover this very, very closely. Now, being in Dallas, we actually liked high oil prices instead of low oil prices. But the price of oil during the Asia crisis bottomed out around $14 a barrel. This was the thing that sort of made the difference for the U.S. economy. We got this enormous positive shock because of cheap energy. Now, what did we all go out and do as a response to $1 a gasoline? We bought, that's right, big cars and SUVs in response. See, this is how economic incentives work. We all go out and we buy SUVs. Now, the Asia crisis, like I said before, it spread to Latin America, right? And because oil prices got so cheap, the Russian economy got into trouble, right? Because Russian economy is essentially a one-trick pony. They depend on energy prices, and pretty much that's all there is for them. And when they got into trouble, because energy prices were low and oil prices were low, they ended up defaulting on their bonds. Right? Is this sort of sounding familiar in some way, shape, or form? When they defaulted on their bonds, a little hedge fund in New York got in trouble. Does anybody remember its name? Long-term capital. That's exactly right. See, this is all connected here together. And the reason it's important for our story today is this. Had anybody, I mean, maybe in this room somebody had heard of long-term capital before that, but I'll be honest, I hadn't. Okay? I don't think Alan Greenspan had heard of long-term capital before they actually blew up in his face. The rescue of long-term capital, well, it didn't really rescue long-term capital, they rescued counterparties. The rescue of the counterparties of long-term capital changed the implicit rules on Wall Street. Implicitly, suddenly, the safety net that used to be reserved for banks that were truly too big to fail, like First Continental, suddenly that was extended underneath all of Wall Street. Now, when you extend a safety net under anybody, what happens to their risk levels? Do they go up or down? Anybody who's got kids knows, right? Can you credibly threaten to leave them in jail? I mean, can anybody do that? Because I've tried, right? I can't credibly threaten to leave them in jail. So you see, because they know there's this safety net underneath them, what do they all do? Take on more risk. It's just human behavior, right? We rock along, though. Everything is fine and good. It's kind of all forgotten. You know, it gets mentioned every once in a while in the press, but, right. Risk levels going, not a problem. We flow through the late 1990s. We have a tech boom and a tech bust, right? And for those of us who were in New York at the time, didn't it really seem awful? I mean, didn't that tech bust at the time just feel terrible? We thought that was a recession, didn't we? I call it a girly recession. Right? That actually was a girly recession, that tech boom that followed, the tech bust. We actually had a recession in 2001, and by this time, I had made my way to CNBC and my, sort of moments there. And I remember at the time actually getting into almost a brawl with a gentleman whose name was Jim Cramer, because this lunatic who I really had no idea who he was or what he was all about, remember, because I'm a Federal Reserve economist. That's my roots, right? And he just started talking about how, the economy's gone to hell and, this is a massive recession and we need to wake up to it. And I'm looking and saying, this doesn't look like a real serious recession to me if you look at the numbers. GDP's never even gone negative. So I'm kind of scratching my head thinking, well, all right, maybe, but that felt like a really, bad recession to everybody else, when in fact it was really kind of just a little girly recession. But for our story, what's important is, how did the Federal Reserve respond to the 2001 recession? They did what they always do in a recession, which is cut rates, but they cut them at the time to 1.25%. 1.25% might have made sense if the economy was going through like a contraction of maybe, say, 3% or something like that. But the economy never actually contracted. And what was worse was that they sort of left interest rates there kind of low for really a long time. And I wouldn't be so critical of Alan Greenspan, except that when he retired, I think that public officials, when they retire, ought to sail around the world, hang out with their pretty wives, play golf, not write a book and, go on a speaking tour, okay? That's for people like me, all right? And so if he was going to write a book, his book really should have been entitled How I Did It. Not, the age of turbulence or whatever. Because leaving interest rates for that low, for that long, really did set the stage for this crisis in the following manner. Have subprime borrowers always existed? Hell yeah. They just used to get their money at pawn shops. All right, subprime borrowers have always been there. The question is, why would banks ever loan money to them? When you couple a financial innovation like securitization with a low interest rate environment that basically squeezes banks' margins, right? You squeeze banks' margins in a low interest rate environment. And if you squeeze anybody's margins, what is the only way to make money? Think grocery stores. Volume. That's exactly right. There's some MBAs in this room, right? The only way to make money is volume. And so basically, you turn banks into pawn shops in a low interest rate that hangs on for a really long time. And so that gets us to the failure of Lehman Brothers. Now, wrapping that into our story, I believe the failure of Lehman Brothers was such a crucial event for the following reason. For the past decade, we'd all operated as if there was an implicit safety net, and certainly, was Lehman Brothers too big to fail? Everybody shake your head. Yeah, yet Lehman Brothers was allowed to fail. See, this is the problem, because you've got markets that have worked with an implicit rule book for the past decade, and you set it on fire, burn it, tear it up, whatever you want to say, overnight. Now, we can argue about whether that might have actually been a good thing to do to sort of break this, too big to fail issue, right? To sort of, that might be the right thing to do. But if you want to know why the crisis got so out of control from September the 15th to about March the 15th, right? 6 months of, as best I can tell, Armageddon. I don't know if you guys had a plan that involved bottled water, a generator, and a meeting place in Arkansas, but I did. And the rest of my family participated. So that really gets us to sort of the snapshot of why I believe this crisis really has been a decade coming, right? A decade coming. But now that we've lived through it, what does the next year look like? I want to draw your attention to 3 things that make this recovery special. Make it its own special event. And the thing that I believe is so important about them is that they will be covered many times by the media, I believe, in a way that's incorrect. Right? That's a way that makes them sort of look bad when in fact they're probably the best thing that could happen to us. The first thing has to do with the savings rate. If I read another column that suggests that a rising savings rate is bad for America, I'm going to hurt someone. Because has anyone noticed that 3 years ago the savings rate in America was what? 3 years ago, savings rate in this country was, everybody knows it. Yeah, -0, right? Every man, woman, and child seems to know that statistic. They don't know what the inflation rate was. They have no idea what the unemployment rate is, but they can tell you that the savings rate in this country went negative for a couple of months. So roughly it was 0. What is the savings rate today? It's been bumping between 5 and 6%. Does everybody understand this is weird? savings rates don't move around. If you look at long-term data sets, savings rates tend to be culturally determined. They are long-term statistics. They are not something that jumps around like inflation rates, unemployment, GDP. They tend to be culturally sort of set. In this country, the savings rate between 1949 and 1980 was 9%. So it tends to stay pretty stable over long periods of time. Yet we see a 500 basis point jump in the savings rate in a really short period of time. That's odd. In order to understand the effect that that has on the economy and to sort of figure out is it a good thing or a bad thing, we have to ask ourselves, why do people save? Does savings feel good? And I want the women in this audience to answer that question, because I'll tell you what feels good. Buying shoes is what feels good. It just does. I can't really explain it. Thank you very much. It just does. It must be something evolutionary. But that's what makes me feel good. We know savings doesn't necessarily feel good, so the question is, why do people do it? Why do people do it? There are only two reasons to save in our culture. We save for two reasons. The first reason is retirement. Right? Everybody wants to retire. This, by the way, is also something that's really, really new, something we really dreamed up in the last century. It used to be for the entire sort of history of Homo sapiens that you were born, you worked, and you died. Now, you're born, you work, you stop working, and you wish you were still working, and then you die. And somehow that has to be funded. And so we save during the period of our life when we are working actively to fund this period of time when we are not going to work. So that's the first reason to save, retirement. Second reason to save is unexpected events. I might lose my job, I might have health problems, my car might break down. When most of us in this room were growing up, what was the rule of thumb for how many months of your salary you were supposed to have liquid in the bank? 6 months. Yeah, you're supposed to have 6 months liquid in the bank salary. Look at him laughing. Stop that. She said 3. That's my girl. She likes shoes too. All right. So that was sort of that was the standard sort of other reason to save. Now, 3 years ago, when people were saving 0% of their income, did they still want to retire? Absolutely. How were they going to do it? With their house. That's right. They were going to do it with their house. I have a 3-bedroom ranch house with no indoor plumbing, and it is going to be worth $500,000 when I retire, right? Yeah, this was sort of the thinking across all of America. And 3 years ago, if I'd been sitting in a room with a group of 25-year-olds and said, what's the probability you're going to lose your job? What would they have told me 3 years ago? 0. And since they're not very good with probabilities, I would say, well, let's suppose that you do. Let's suppose that you do. What would you do? And they would say, well, I'll refi my condo. I get these little credit cards in the mail that, 0% interest, and you can roll over the balances for a year. It just won't be a problem. What about today? Do people still want to retire? Yes, they do. And how much do they think their house is going to be worth? Nothing, right? And which is true if you have one in Las Vegas. Yeah, they think it's going to be worth nothing. So they still want to retire, but they can't do it with their house anymore. And what's the probability they're going to lose their job? Yeah, it's about 5%, because the unemployment rate is 5% above trend right now. So normally the unemployment rate runs 5%. It's currently running 10%. So the likelihood you're going to lose your job is about 5%, okay, in that environment. So yeah, that's a big probability for many of us. And so we suddenly see people starting to save again. Now, what's worrisome about this is that I read the papers and I hear a lot of well-known economists who win Nobel Prizes say we've just got to get America spending again. And my response is, I don't need a PhD or a Nobel Prize to figure out that if spending is what got us into this problem, then it can't possibly be the thing that's going to get us out. Don't you think we would have all been better off if everybody in America had 6 months' salary sitting in a bank account somewhere to get them through this thing? Yeah, I'm thinking, because I don't care what GDP is next quarter. I really don't care. It doesn't matter to me. What I care about is living standards 3 years out. And if we saved 6% of our income month in and month out, 3 years from now, our living standards will be higher, not lower. And it does a disservice to most Americans to make that shallow argument when it's not true. We will be better off if we continue to save 6 months, year in, year out. Now, is the transition painful? It is for Neiman Marcus. Yeah, it's painful for the retail sector to transition from an economy where people save 0 to an economy where the equilibrium is where people save 5. But that equilibrium over the long haul is better for all of us. Now, second element to the recovery over the next year has to do with house prices. I actually think that house prices hit a floor in 2009. They hit a floor, but be very careful and listen to me. They started collapsing in 2006, and I believe they hit bottom in 2009, and here's why. If you look, the median household income in America is $55,000 a year. Now, with just sound financial planning, how much house can they afford? And before you answer that, remember, what is the financial rule of thumb? How many years' worth of salary, just 3 years of salary. So if you multiply your yearly income by 3, that gives you how much house you can really afford, and still, eat. So if you make $100,000 a year, you can afford a $300,000 house. And people can say, well, there's no $300,000 houses out there, right? I'm like, oh, yeah, there are. They have wheels on them, and I've lived in them before, so I don't have a problem suggesting that to somebody. Now, not $3 million, by the way. If you make $100,000, you can afford $300,000, not $3 million. So if the average household makes $55,000 a year, how much house can they really afford? $165,000. Yeah, you're better than the undergraduates I teach. They would have been stumped for hours on that one. Yeah, $165,000 is what they can afford. Now, 3 years ago, at the height of the housing boom, the median house in America cost $212,000. Any guesses what it cost last year? $165,000, actually. It fell to $165,000. Now, it's very painful if you bought a house in 2006 and you're now sitting there with an asset that's worth considerably less. But the condition for stability in the housing market was that the median household must be able to afford the median house. They must be able to afford the median house. So house prices had to get that low before the markets could stabilize. Now, does that mean that we don't still have a volatile housing market? We're still going to have a volatile housing market. You're going to have an enormous wave of foreclosures next year because the worst loans were made in 2006, and it takes 4 to 5 years for those to work through the system. And they were houses that were going to go bad. They were loans that were going to go bad no matter what. Recession, no recession. They were going to go into foreclosure. It didn't matter for the reasons that I talked about earlier. So I believe this was the bottom, the worst year for housing, but here's the bad news. Yeah, exactly. We got a realtor in the office. That's the bad news? Okay. What we know from examining previous booms and busts in the housing market is it takes 10 years for prices to recover peak to peak. So if house prices peaked in 2006, right, 2006, they bottom in 2009, 2010. You don't see those old prices until 2016. Now, not every market's the same. New York could easily recover quicker than the rest of the world. And I think that you're probably never going to see prices in many cities ever get to where they were before. I think the coast recover quicker because everybody wants to live next to the water, myself included. But the desert doesn't recover quickly because the only people who can really live out there are monks and scorpions. So, it's not the same all over America. But I think this is the worst year, and that the worst for housing in terms of prices is probably behind us. Third thing, though, third element, which sort of wraps us back around to our original discussion, where do the jobs come from? How are we possibly going to have job growth in 2010? I think it's going to come from a very unexpected place, and we're seeing it in the numbers already. In the third quarter of last year, exports from the U.S. to the rest of the world grew 17%. A couple of months ago, there was an enormous piece of news that came out. China's exports had increased by something like 20%. Do you know what their imports increased by? 56%. Yeah, it's stunning. It's stunning how we don't understand this import-export picture, but it's extremely important for what I think will take place over the course of the next year. Because most of the world does not think the U.S. makes anything. right? If I just walked down on the street and started talking to the tourists, because the New Yorkers wouldn't talk to me, but if I started talking to the tourists and I said, you know, exports are going to lead growth next year, they would laugh and say, we don't make anything anymore. But that's actually not true at all. We make the world's capital goods, we make the world's software, we make the world's food, we make the world's entertainment. Up till 15 months ago, we made the world's financial services. We make lots of stuff in this country. We even make sort of soft goods. I was in a hotel in Washington, D.C., and I looked down in the shower, and I saw this cute little box of shampoo. It was just precious. Little box of shampoo, and had all the little environmental stickers all over it, because apparently once you open it, it biodegrades and turns into like jelly in 30 seconds or something like that. I mean, it's just wonderful. No waste, right? Because it's single-serving shampoo. I thought, that's just a genius idea. How clever and wonderful. I wonder where it's made. And because I'm an economist, I picked it up, and what do you think I expected to see on a little bucket of shampoo? China. It was made in Indiana. It's made in Indiana. We even make things like that. We make a lot of things here. Now, most people would say China's the world's largest exporter, and that's absolutely true. But who's number 2 and 3? The U.S. and Germany. We vie for first and second and third place over and over. And as an economist, I don't ever just look at total numbers. I look at per capita numbers, because they're actually more important. And anybody who's got 2 kids versus 10 kids understands this completely. Or 0, for that matter. That's what I'm going for lately. All right? Per capita numbers are what matter. If you adjust China's GDP and their exports for their population, they're not such a big economy. In fact, if you adjust their GDP for population, they don't make the top 80. They're actually, per person, right, quite a small economy. So exports adjusted for population, that's what really matters. So we're actually a very large exporter when you look at it per person. And what determines our exports? Why would I say that our exports are going to grow next year? Well, 2 things. Number 1, the value of the dollar. Anybody paid attention to the value of the dollar over the last year? Has it been going up or down? It's been going down, right? And a lot of people are alarmed by this. But from an economic point of view, as an economist, I look and say that makes our exports more competitive relative to Europe. So I'm fine with the dollar declining. I don't have so much of a problem with it. But even if it stops declining, I still think our exports will go up, and here's why. The wealth of our customers. Now, who are our customers for our exports? The rest of the world, right? And the funny thing about this financial crisis, it's really been about the U.S., Japan, Europe, and Iceland. The rest of the world kind of grew through it. And I think it's related to what I talked about earlier. They had their financial crisis already. If you look at Brazil, Asia, Mexico, Argentina, all those countries suffered in the late 1990s, and they made significant financial reforms in response to their own crisis. They kind of had their crisis already, so they kind of grew through this one. They didn't have the banking problems that we did. They didn't have the loan problems that we did, because they kind of did that already back in 1997. They are our customers, and when you look at them, they're almost having like this 1950s moment. In the U.S., in the 1950s, we went from being subsistence-level farmers to middle-class nation. We got storage bins and garages. That's basically what happened. And that is the moment that many high-population countries find themselves, right there in that moment. And when they do that, they buy our stuff. They buy our stuff. And I say it over and over again, don't shoot at them. Don't shoot at them. I want them to buy our stuff. They're our customers. Never, I mean, has anybody got a business plan that says, shoot at the customer? Never a good idea. So, when I look at the next year, what I think we will find is that the savings rate sticks at 5%. It's been a difficult transition. It's really been what this recession has been about, moving from that old equilibrium to this new equilibrium. But the savings rate sticks at 5%. I think the worst is over for the housing market, but it is a long, slow climb back out of it. There's no reason to think that home prices really should appreciate any faster than the rate of inflation. I mean, we're not a population boom country. I mean, if you had a population boom, housing might go up. But housing in and of itself, no reason to think it would go up any faster than the rate of inflation, which means you get a long, slow climb back. And then finally, I expect job growth in the next year, and it's going to come from an unusual place. I think it's going to come from the export-oriented sectors in our economy, and it'll be a story that surprises everybody. And with those thoughts in mind, Michael, can I take a few questions? Yes, yes. So I can take a few questions if anybody has one, and I can hear, so I'll just repeat it back to the rest of the room if anybody has any.
What about
Yes.
your major, like, manufacturing? Like a lot of the stuff that we make is like small stuff, but like a lot of the like the tankers that are going across to Asia, like get filled with like empty cardboard boxes and come back with TVs and other things.
Sure, sure. Yeah, what about the composition of our exports? Because if you actually look, we get lots of containers coming over here filled with our clothes and our shoes and our soft goods and our towels and our things like that and our toys and all that. And it doesn't appear as if we're sending a lot back to the rest of the world. We send all these empty containers back. And it is true that a lot of what we make, particularly when you think about software, doesn't fit in the container. It just doesn't. So a lot of our exports to the rest of the world tend to be service-oriented. They're not heavy manufacturing. And there is this kind of old idea that you got to make something, right? But I got to ask you, if your kid comes home from college and says to you, you know what, I don't want to be an accountant, I want to work in a tire factory in Akron, are you going to be happy? Definitely not. Or you might be, depending on what their grades look like. But the reality is what we produce doesn't fit in tankers. That's absolutely true. And we don't even make the boats that they go on. The Chinese do that as well. But I don't really have a problem being in a more high-tech area of manufacturing. That really doesn't bother me. And again, you have to adjust for the population. You have to look at population, exports per population, and when you adjust that way, it's true. The things that we make are harder to see, like your little iPhone, right? I mean, it's true, it doesn't get snapped together here, but does anybody have an iPhone, or anybody not have an iPhone in this room? Maybe that's a better question. If you get your iPhone out, you can't see it in this light, but do you know what it says on the back? Can you read what it says on the back? Where does it come from? Everybody has to take the little plastic thing off of it. That's a racket, let me just tell you. Here you go. Okay, what does it say on the back? Yeah, exactly. Close. Get the candle. That's right. Assembled in China. That's right. It's designed in California and it's snapped together in China. Which business do you want to be in? Do you want to be in the snap together business, or do you want to design the thing? I think I want in the design business, definitely. But excellent question, and hard to get your brain around, right? Because you want to see it. But we have to look beyond, the tanker ship and think iPhone. Yes, in the back. Sure. What about, what if China decides they don't want to hold our debt anymore? Well, it's a standard money and banking issue. When the price of a bond goes down, what happens to the interest rate? It goes up, right? So if interest rates rise, bond prices fall, right? If the Chinese stop buying our debt, what happens to interest rates? Do they go up or down? Up. And who's the biggest loser there, them or us? Because they're sitting on a big stack of it, right? And so it's a game theory issue. It's really a game theory problem. They have no incentive whatsoever to stop buying our debt or to bail on the debt that they've got right now because they are holding the bulk of it. They would lose financially because we'll find somebody else to buy it. We'll find somebody else to buy it. We might have to pay a higher interest rate, but I've lived in the United States of America when the 30-year Treasury was trading at 7%. I did just fine, and so did you. It wouldn't surprise me to see we're going to have a much higher interest rate environment going forward. That's just a given. It's a given. It's baked into the cake. You get a higher interest rate environment because you get higher inflation next year. I believe the real rate of return picks up, and risk premiums, particularly on government debt in the United States, given how much we own, also are going to pick up just a little bit as well. So the higher interest rate environment's baked in the cake. But the biggest losers, the reason I don't stay up at night worrying about the Chinese dumping our debt is because they'd be cutting their own throats, and they don't seem to be, that dumb. All right, thank you very much. I have to turn it over for the next speaker. I appreciate your attention. Good night.